out more about Franklin Cudjoe, you can find out more about Bright Simmons. We also have Ben Boachi, and he's also an energy governance professional and the executive director at Africa Center for Energy Policy. Please just wave to us briefly if you can hear me. Franklin, can you hear me?
Oh yes, I can hear you, Noam. Thank you very much.
Get a wave, please, from our rapporteurs. Just give us a wave so the audience can see you.
I can hear you. Thank you.
Oh, I can hear you. Our rapporteur.
Awesome.
Okay.
So after they speak, I'll be opening up the discussion for your views, all of you that are tuned in. I need to remind you to please mute yourself and your videos so you don't accidentally trip into the meeting. So later we'll be taking your views on the main agenda. That is actually the main item on this meeting, your views. That's the most important thing. And me, I usually tend to introduce everyone and forget to introduce myself. And so I am Nuong. I'm Nuong Falong. I'm a journalist. And I will be moderating the conversation. So I should also let you know.
Okay. Hi.
Hello.
That's fine, Neon, you can go ahead.
So I should also let you know that during most part of this webinar, if you want to make a contribution, please just raise your hand. You can see that function. You can also just leave a message, it's easier. And then I'll be reading out your questions to the right person. You can also actually choose who you want to answer what specific question, and it will be directed to them. That's not a problem. So let's not waste much time. We'll be moving right into it. And I'm going to call on Franklin Cudjoe from IMANI, Ghana. And he's going to remind all of us of today's gathering, the most important thing today.
Well, thank you very much.
Frank, please help us. Yeah.
Well, thank you very much, Noam. Thank you very much for accepting to do this for us. It's very rare to find spirited souls like yourself to be part of very important national conversations such as this one. My job is pretty simple. I know that almost every Ghanaian, and there are other foreigners joining this call, by the way, who have been following these conversations, the controversial conversations around Agyapa. And I think everybody seems to be very much interested in what it is that Agyapa actually means. Indeed, if it's supposed to be inheritance, then it means that it ought to be shared accordingly and equally. So this afternoon's conversation is pretty simple. We just want to ensure that the partnership approach to governance, the governed and the governing, must be enhanced. The governed must be listened to, as well as the governing as well. And I think that even though we do see what appears to be some unequal relationship in this partnership, we thought it was important to host this town hall meeting so that the governed, however representative, however minute the number, can echo a lot of the concerns that people have. It's not supposed to be name calling. It's not supposed to be hurling unfair accusations at anybody. There's supposed to be a didactic conversation. And I expect that everybody contributing. Of course, I must tell you that there are government persons who are like sleepers also on this call, which is very useful. I've assured them that this is going to be a very interesting conversation, and so they should take part. So however they do it with aliases, it's even better. Let me just say that this conversation started much earlier with the active, involvement of CSOs, and the CSO coalition has been very, very dogged in this approach. We've had meetings upon meetings, we've issued statements, and we thought that just so that the governing party doesn't think that everything is kosher and that we are sleepy, because we've not heard much from them since we met, it is important to bring the conversation back to life. We certainly hope that this may be the final of these conversations, because presumably once we get Ghana views on here, those views would definitely feed into the final paperwork for the Agyapa deal. Otherwise, they would leave us no option than to activate many, many international angles. And boy, there's been so many international interests, from The Economist to the Transparency International to the Guardian newspaper. There's just a number of them that are interested. But in all of this, I keep asking myself, why can't we solve our own problems, right? We can. It's only when we externalize our problems that we tend to show that we are quite divided. And we think that these conversations now being had would prevent us from, as it were, washing our dirty linen outside. But the vehicle that is being adopted itself is not necessarily a localized one. It's also supposed to have active international players. So at the risk of sounding as if with this an indigenous conversation, I must admit that the international people are also pretty much involved. In fact, there are some investors who are on this call as we speak, who may be interested in buying some of the shares. They shouldn't be alarmed. This is an important conversation, national conversation. We do not intend nationalizing any assets. We're only asking for fair share of this asset. So with those comments, all right, so I'm done. Nyon, over to you. Oh, you muted yourself. Got to mute you.
A quick reminder, please, to everyone to just mute yourselves. Thank you very much, Franklin. Indeed, we can solve our own problems and we are very capable. So I'm hoping that at the end of this conversation, we will all be more informed about the Agyapa agreement. And I will quickly call on Bright Simmons, who is Franklin's colleague, and he will tell us, for the benefit of those of you who are yet to know more about Agyapa, I'll let him give us a very detailed overview of the agreement, and then we can move on. So, Bright Simmons, please, if you can hear me.
Thank you very much, Nyon, for excellent moderation as always. I'm going to be turning off my video as I go into sharing my screen as soon as I've been allowed to do so by the host. Once I start sharing my screen, I will move to putting off my video so that I can save bandwidth. So this is not out of discourtesy. Thank you. So I'm waiting for Franklin or the host to give me sharing rights, either by making me a co-host or the host.
Are you able?
You have to make me co-host, or just click on my the three dots you see next to my profile. So you don't have to share your screen. You have to give me the right to share my screen by clicking on the three dots next to my name and making me co-host or host.
Yeah. 1 second.
Okay. In the meantime, let me acknowledge a few of the people that have also joined us. I see Shatawale. I don't know if that's someone's pseudonym or Shatawale is actually with us. Welcome, nonetheless. Thank you for being here. Dominic Hateka, thank you for joining us. Give us a little wave. Nafi Chinri, I see you again. Nuruddin, Peter Chikata, thank you so much, all of you, for joining us. Please remember, just mute yourself so you do not interfere with the main broadcast, and just leave your questions, leave your recommendations in the chat. I will read them out to the right person to take them. And we'll just move back on to, are you ready, Bright Simmons?
No, I'm waiting to give instructions so the host can.
I see you're a host now. You're a host now.
You're a host now.
You should be able to do that. You've been made a host.
I'm the host, but I'm just waiting for Franklin to stop sharing his screen. He's forgotten, and his screen is still on the.
All right, I've done that.
Thank you. Okay, thank you very much. Apologies to the audience for the technical hitch. So, Noam, can you see my screen? Because if you can,
Yes,
then everybody
I
else
can
can.
see you, which means you're on.
Thank you so very much. Very grateful. So first of all, we're very thankful for the time that all of you are spending with us. We're going to have the town hall conversation. The problem is that not everyone has followed this particularly elaborate situation that we call Agyapa, the royalty saga. It's not a complex deal, but it's very elaborate. It has a lot of moving parts. So it requires time and attention to research in order to be able to unpack the details. And I thought that because a good number of you might not have had the time to do it, it will help if I kind of lay out end to end the government's position and the CSO's position. Having done that, we can then proceed to have a conversation. So first, I'm going to spend a few seconds just saying that the CSO community has not been happy with the way that we've been treated as if we do not have a seat at the table. When it comes to resource governance issues, we fought very hard for a seat at the table. And we're not going to see that seat to investment bankers. It's not happening. When Ghana became a pilot member of the Extractive Industries Transparency Initiative, it was on the back of serious activism by CSOs to bring transparency to bear on the exact issues that we are discussing today, issues of revenue and distribution of revenue. Royalties are revenues that government earns from minerals that they hold in trust for the citizenry. And these are the very type of power imbalances and information asymmetries that we set out to resolve when we created EITI. Nobody forced Ghana to become an enthusiastic member of EITI. I think it's now one of 53 or 52 countries that has decided to do this. We think that Ghana has begun to break faith with the resource governance movement by pretending as if this interest that we have in all the details of Agyapa, in every single little detail of Agyapa, is unreasonable. It's not an unreasonable demand. We didn't ask Ghana to join EITI. We didn't ask Ghana to go looking for international praise by stating that it's transparent and that it discloses information as and when relevant to all key parties. We did not ask Ghana to commit to a multi-stakeholder mechanism between government, industry, and civil society, which is enshrined in the EITI standard. And then we've seen that since 2016, Ghana is not capable, it appears, of meeting its obligations. I know Dr. Mantio is on the call, and he's made several attempts to collect information related to disclosures, and has been stalled. And this is the same thing happening in respect of Agyapa. So the reason why the CSOs are really taking on the government on this matter is because they promised us. They came to the table and said they're willing to have a multi-stakeholder arrangement regarding revenues, disclosure, and the like. And now they are not doing that. So it's not that the CSOs are being unreasonable and are demanding too much. No, we're holding the government to account. The very things it promised to do, which it is not doing. Through the EITI standard, we are entitled to every single dimension, information on every single dimension of the Agyapa deal. And that's the only thing we are certain, nothing more. So, as I said, this whole conversation is in three parts. I'm going to lay out what the government's view has been in the interaction that it's had with civil society, and I'm pretty sure with others as well. Then I'll go into more detail where the CSOs diverge from the government's position. And then I will conclude by trying to establish whether or not government's own intentions are met by the structure that it's proposed. What government wants to do is threefold. It's not complicated at all. It's really simple. They've got a short-term agenda, they've got a medium-term agenda, and they've got a long-term agenda. They want immediate cash for investment, and they are arguing that waiting for 10 years to raise that money step by step may not be smart because we have immediate needs now. So why don't we get some of that money right now for investment? They are saying that in order to get more money to support the budget, we need to go beyond just royalties. We need to start investing in some of the mines that are local and beyond Ghana in order to get more money through dividends year by year to support the budget. So think of it now. Right now, most of the money that the government makes comes from royalties. The equity stake yields very little. In some cases, nothing. There are mining companies that have not paid a dividend to the government in respect of the government's 10% equity interest for years. Then you've got these tiny amounts of rents that they pay to chiefs here and there. which is very insignificant, and the communities get very little because all the money that is going to the communities is coming from royalties. Royalties is only 5% of the gross bullion proceeds. When you mine the gold and you sell it, whether or not you make a profit, we take 5%. And because you don't have to tell us how much you made before you pay, we don't care if you don't make money, we still get it. It's been the most consistent part of the returns. The government's argument is that it's not enough. 5% of our natural resource is not enough. You need additional money to be able to go into investment in the mining sector itself, where they get more returns than just royalties. And thirdly, the view is that our resources are valuable. Sitting in Ghana, they are being undervalued. If you put it on an international stock exchange that is respected worldwide, the value of the assets themselves will increase, and government might be able then to monetize them through other means. So it's these three things that we are going to measure if what the government says Agyapa can truly deliver according to this three-step benchmark. Short term, medium term, long term. Get cash right now, get more cash every year, and then maximize the value of the asset eventually. Three important criteria by which all of us need to assess Agyapa. This is the way that government sees the deal. There is money that the mining companies have to give to Ghana. There are more or less two main categories of that income. One category is the equity that we own in these mines. If you want to mine in Ghana, we have 10%. In gold, definitely. In some of the other minerals, we have even more. I think in bauxite, we are increasing the equity stake. Beyond that, because we have the equity, we expect that you pay us a share of the profit every year. That's called a dividend. So that's one major category of income. This is the one the government continues to insist we are not getting. The second part is that regardless of what you do, whether you make money or not, so long as you mine minerals in this country, we take 5% of the minerals, but more or less we receive it in cash. In some instances, we sign agreements with companies that allows us to vary that 5% to 3% to 5%. I will prove to you later on this call that it's even simple as that. So that money is the gross proceeds, and in many ways, it constitutes by far the largest proportion of the minerals we get, which is the royalties. There are a few other areas in terms of applications to Environmental Protection Agency and other agencies. We also collect some money from the mining companies. All of these are disclosed in the Ghana Extractive Industries Transparency Initiative reports that people like Dr. Stimantiao, Ben Butcher and others work very closely with and are experts in, and you are happy, you should feel free to reach out to them to get these reports. They are publicly available. You can see in great detail where the money comes from, where they go. When this money is paid, the government decided that we don't want to put them in the consolidated fund, which is the fund where the portal you put all manner of income in. We want to put them in a special vehicle called the Minerals Income Investment Fund. And that money is then allocated in a format. 20% is supposed to go to the Mineral Development Fund, which was supposed to help the communities. For a long time, the government doesn't manage to make that 20%. It's been struggling to hit around 8% thereabout. I think they want to reduce it now to about 12.5%. Now, instead of the money that was to go to the Mineral Income and Investment Fund staying there, the way the government understands the deal is that it wants the 75.6%, that is minus the 20% that goes to the Mineral Development Fund, which will remain untouched. It wants the 75.6% to go into a special vehicle whose value can be maximized by putting it on the international stock exchange. And the 2%, the 0.4% that you see missing there is money that's supposed to go to GRA and to stay in the MIRF, the fund, this fund here. A small amount, 0.2% is supposed to, 2% is supposed to stay there and reduce the, to be used for administrative overhead and things like that. And then a small amount of money is also supposed to go to the Ghana Revenue Authority to help them with the collections procedure. So this is what the government thinks is a very straightforward proposition. Money that was supposed to go into the Mineral Income Investment Fund based in Ghana should now go to an entity based in Jersey for tax efficiency reasons, but mostly so that it's easier to list on the London Stock Exchange. And the argument is that by so doing, they will increase the value of the resources. First of all, by getting international investors who, because they are assessing it from a London jurisdiction, will, for some reason that they believe, will value it better than we can value it. And then because the vehicle is now a company on its own, so it's not just the assets that are being dumped on the stock exchange, they want to build an operating company, which will become a royalties company. So that company will go around the world looking for mines and to sign deals with the mines. This is the way they work. They will pay money to the mine, tell the mine that use this money for development of the asset, and then you give us a fixed income stream down the line going forward. And the argument is that some of that money will come into the Ghanaian mining sector and improve the Ghanaian mining sector. As far as the government is concerned, there's nothing wrong whatsoever with this structure. I must point out that until we terminate at the level of listing on the stock exchange in London, and some of the other issues I'm going to come up with later on, most political parties and civil society and the rest of it don't have a fundamental problem with an attempt to create a special vehicle, put in the resource and try and maximize it. The challenge is the way the government has decided to approach it is the big problem. And even the most ardent nationalists in this matter think that using some private sector expertise, we can do more with the resources. But we recognize that this is the way the government understands the deal, in which we disagree, but those details will come as I proceed. The government also thinks that, you know, the royalty company model is such a brilliant strategy because when you compare them to the two major type of entities or two major type of channels through which an investor can benefit from gold, it's the best because the royalties come when the companies make a profit. They have to pay the royalty. So when the price rise, we get all that benefit. If the company's cost rise, we don't care. So given that context, it makes sense to use the gold. It makes sense for investors to value a royalty company by a lot, and therefore Ghana creates a royalty company. Investors will be more inclined to invest in that entity than they'll be inclined to come directly and invest in our gold mines or use the money in some other form like an index fund or some other strategy. So in simple terms, they're saying that when you look at a royalty company, it benefits from all the upside and benefits from none of the downside. There are a lot of issues with this thinking because we will also be able to tell you that royalty companies are seen as not sufficiently leveraged, etc., etc. But we're not going to go into those details because they're not that relevant. What is relevant about them, I'll come to in a later part of the conversation. This is what the government sees the dealers, and a lot of the confusion arises from how the government has set up this, whole structure from the communications point of view. So this is the way the government understands it. There are 16 assets, and they call them assets, and we'll get into that in great detail. And these 16 assets, 12 of them are producing, and there are 4 of them that are yet to start producing. So a lot of people immediately think they are talking about mines, but they are not talking about mines. In fact, I'll show you that what they are talking about is very hard to clearly delineate, but that will come later. They also think that the gold that we are talking about, the underlying production of gold, is about 2.9 million ounces. And this 2.9 million ounces is what we produce every year that is relevant to this deal. So most of you will have seen that we are now producing almost 5 million ounces of gold a year, which is why we are the largest producer in Africa. But what they are saying is that it's not all that gold that we are talking about in respect of this Agyapa deal. We should focus on the gold that is covered in the agreement. And it's that gold that they are taking a percentage between 3 and 5%, depending on how you calculate the average or aggregate royalty number. And it's that percentage that we're going to put into this vehicle and list the vehicle on the international market. They also think that the companies will be, every year, the profit that the companies make, about half of that amount will be coming to dividend owners, people that are entitled to dividends. So this will be the shareholders primarily. So Ghana will be getting about 50% of the profit of the company every year. So one of the things that you could quickly start running through your mind is, okay, every year we know how much royalties we are getting roughly, right? So what profit will this company make and what will 50% look like? Will that be similar? Then you also have to look at, okay, we have got this gold that we're giving to other people to come and own a piece of. How much money are we making upfront, as the government insists, it's so critical that we do. This is also another important part of the economics, because now the government goes into somewhat detail about the so-called assets, who operate them, what is the effective royalty rate, because don't forget, some companies have managed to negotiate that because they are putting so much in the country, the 5% is too much. So they pay depending on the price of gold. So when the price of gold is about, I think, $1,700 or something like that, and most of them pay the 5%. When it goes below, the amount of royalty they pay starts to reduce as well. And the reason is that we take the royalties regardless of whether or not they are making profits. So the idea that sometimes it's really hard for them to pay the royalties when the price of gold is down. And we've agreed with some of them because they have immense, if you look at it clearly, you can see that it's the big companies that have been able to force the government to agree to this. Newmont, Anglo Gold, Gold Fields. Most of the other companies are stuck with the 5%. Now they've then gone ahead and then giving you an idea of, for each mine or each asset, how much production is being recorded for each location, how much was the cost price. The AISC that you see there, last but one on the column, is basically how much it costs for each mine to produce the gold. So essentially, it gives you an indication of their profits. And that might be necessary for risk management purposes. If the company goes out of business, you can't get even your royalties. But the royalties have no connection with the profits. And then they give you a very interesting list, which is they give you an attempt based obviously on the reserves of how much life is left in that mine. And then they give you a number of assets, which are, it's hard to explain what an asset means, but think of it like, project. But it's not even a project. Think of it as, right now, think of it as a company, because that's the only way it makes sense to kind of grasp what they mean by an asset. So a number of different companies who are not yet producing, but who will start producing. And to them, when you add all of this up, you get about 2.9 million ounces of gold a year. We take about 5%, roughly 4.5% is what I think they like in terms of trying to figure out what is the effective royalty. And then they get some numbers around $100 and something million a year. Then they project it, and then it's giving them this $1 billion figure that they think is reasonable. We're going to turn into this in great detail because a lot of things hang on this valuation question, but it's not everything. It became somewhat unfortunate that people have started to think that all the other problems we were raising with the CS were back down, and now we're only talking about valuation. Valuation is just a technical matter. It should be left to investment bankers. That doesn't make sense. It's a resource governance issue. Valuation is technical, but every MBA can do valuation. It's not rocket science, but there are issues as well, is what I want to say. Now, what are the CSO's view? And why don't we believe a lot of what the government has told us? Why do we disagree with a lot of what they've said? We're completely baffled and bewildered by some of the things they are claiming. Let me go into that. First of all, the way that they understand the gold market, if you're an investor and you want to benefit from gold, completely simplistic. There are so many different channels. And while royalties companies are important, so you can see royalties companies on there, there are areas where royalty companies are also not that beloved by investors. There are issues in relation to the capital gains rate, etc., where if you take into account, and I'll show that in the subsequent slides, take into account current hurdle rates in the market, what investors expect to earn. In many cases, royalty companies are not that exciting, which is why there are so few of them, which is why most of them are quite small in terms of the revenues they make. The most important of these companies makes about $1 billion a year. Compare that to some of these technology companies that makes $100 billion a year. There's a reason why it's a small niche industry. There is a limit to how great they are, and we'll show that. But the government has this view that if you take our view, which is a much more complex view of the different ways in which an investor could benefit from gold, makes a royalty company not necessarily the greatest 10-cent sliced bread. But we'll come into greater detail why that matters for this analysis later. The other thing we also need to point out, it's not a traditional royalties company we are trying to build. And the reason is that typically if you go into a royalties transaction, you are determining price, you are determining volume, you are negotiating all of that upfront, and it's very clear. So I'll tell you that, if you give me this quantity of gold over a certain period of time, I'll give you this amount of money upfront and maybe some other payments down the line. And I'll tell you how much volume that is guaranteed, etc., etc. None of that are really in the Agyapa deal now. But we haven't really set up the royalties company. We are now going to set up the royalties company. It's the royalties company that's going to enter into these types of relationships. So right now, what we really must be focused on is the assets we have, which is going to be used to capitalize the royalties company, which will then raise money. So the government's attitude of pretending as if we already have a royalties company is a bit of a joke, and then trying to use some multiples that are relevant to royalties companies all don't add up. What we have is an attempt to create a sovereign vehicle, which will become the core of a royalties company. So our valuation must start from the assets that we have, which we are going to put into some company and sell in the market. And it's very important that we keep that in mind. Secondly, also, because what we are doing is not very common, I don't know of a single sovereign-backed royalties company in the way that we are trying to do it, where they've just taken all the future streams of a particular asset and put it in a vehicle they're trying to list on the stock exchange. So investors are also going to be somewhat perplexed. And generally in the market, people don't understand what it is you are trying to do, as well as they don't have other benchmarks, and you don't have a trading history. You don't have management that work in the royalties industry. When you wanted to hire management, a CEO, you hired someone with zero royalties capacity as in working for one of the top royalties management company. That's not what you've got. And you've got a CFO who was really in cement and a whole bunch of other things that are very confusing. You can't even tell us your full list of directors. You have no trading history. You have no accounting history. You've been operating for a year. When we've asked you for the accounting details of this company that has already been functioning for almost a year, this is Agyapa Ghana and Agyapa JC, you can't provide any of it. Whatever it is that you are providing to the investors, and we'll come to that as well to help with evaluation, we have to recognize the fact that the information that is available now about Agyapa does not give an investor the full confidence for them to value Agyapa well enough. And here it's a very subtle point, because on the one hand, we say that they undervalue the asset, but on the other hand, we are saying that the market will undervalue the asset. Which is which? It's simple. We know our gold, and we've been dealing with our gold for years, and we stay here. There are a lot of people that are specialists in Ghana, and they understand our gold, and they know how to deal with our gold. If you are going to the market, it's not that's not what you are taking to the market. You are taking that to capitalize a company, which is essentially give it revenue, because a company will typically have working capital. Because you don't want to start with debt and you want to keep it simple. The working capital you are giving to this company is the gold. It is that simple. It's the gold streams. Now, this working capital that we're giving to the company is now going to create a company that will go and find mines and invest in them. Every investor that is evaluating is evaluating the long-term prospects of that entity, not the gold that is coming in and not the fixed royalties that will just come in. They're also evaluating whether or not that money can be used to enter into relationship that will grow the company. Or if it was just a matter of the royalties that are just coming, then why are we going to create a royalties company? You might as well just go and do a securitization. Go and see a bank and tell the bank that give me some money, and then to pay for it, I'm going to open an escrow account, and every money that comes from the royalties company will go into it. So it's important to realize that we are not going to try and create a royalties company. There are companies that have been operating since 1986, and they have a lot of history. They have management that are known in the industry. You are not going to create a new startup, and that is why the market will undervalue it. So when we say the market is undervaluing it, we agree with them, but not in the way that they think we are agreeing with them. We are just saying that you don't put all your eggs in a basket where that basket has leaks, because of the way the investors will perceive that entity. And that's a very important point that we wanted to make clear. Secondly, the government also just makes some bizarre statements about why the market will really reward this entity. And may I ask Franklin or whoever is the host to please let in the people that are waiting in the waiting room. There's about 29 people in the waiting room that must be let in. Thank you. The other thing is this number of bizarre claims that they've made. For instance, they say that Agyapa is highly diversified. At the same time, they will tell you that it's a pure gold play. I mean, either you are highly diversified or a pure high gold play. For companies that are highly diversified in the royalty space, they are mixing metals. So if you look at Triple Flats deal that we were doing Royal Bafokeng, they could have mixed palladium, platinum, etc. in the portfolio. Of course, they did gold in that instance, but they have other portfolios which are other minerals. Wheat, that's a lot of silver, far more silver than gold. Now, that is what we call diversification on the metal side. Secondly, the geography is Ghana for now. It is now that you're going to build diversification by going to other markets. We don't even know whether you get the deals that are necessary. So that is quite important that we keep in mind. That is not diversified in the way that they are telling us it's diversified, because it's just a gap-based resource for now, and they have to justify to the market that they can't create the diversification. Gold is just gold. There's no other minerals. On top of that, the upside that they are talking about is limited upside because it's just price and production. We don't have anything to show the market that we have people with the skill to select projects that are extremely effective on the exploration side, on the development side. This entity, when it comes into being, is saddled with legacy projects, because the government is just putting in legacy projects, right? There is no way you can then tell us that all the projects that are in the portfolio are those that an investor will value highly. An investor is saddled with a bunch of legacy projects that you put in a vehicle and then you are listing. So the diversification doesn't really exist. And then all the projects are also just mine projects, really, because that's all you've got now. There are no other projects where, for instance, somebody is doing kind of like a recovery or whatever, and they want you to invest in the recovery strategy for technology or something like that. And therefore, you can see that we are diversifying from just pure production into some of the technology-related elements that are also emerging in the market. So that is quite important that we bear in mind. Okay. Now, let me go on to the next point. That's relevant. So we now move into the issue around evaluation and why we say the evaluation. So now we've shown that, you know, there are a lot of issues with the way the government sees the deal, but we're not going to go into where we disagree with evaluation. So when we start, it's important that we pay a lot of attention to the valuation, because despite what the government has said, which is that the market will evaluate, it's not a market that will evaluate. And if we get a bad valuation from the start, it will have an effect ultimately on other opportunities and prospects going down. So one of the first things that you realize is that this company has no working capital. This company is going to go into this whole listing thing with nothing to its name. So it's going to have to borrow. And now if it's going to borrow against its balance sheet. And this balance sheet, as we'll show in a second, is really the gold in the portfolio that we have. The value of that asset is going to determine its balance sheet. And the amount of debt is able to borrow and the terms and all of those things will be primarily determined as much as possible by the fact that in these kind of situations, the valuation of that core asset of the company is sensible. Secondly, they have to raise huge amounts of money. I mean, Goldfield's demand investment alone is in the region of $350 million. There are far bigger projects in the country, which requires a lot of money. So if you are going to come into Ghana as an example, and do deals in Ghana as a Agyapa royalty company, you are going to have to put in huge amount of capital to be significant. People want you to be putting in $100 million, $200 million, and things like that. Now, here is the problem. If your capital structure is poor, if your balance sheet is weak, your ability to raise debt to do that is bad. Secondly, if you raise debt, it has an impact eventually, as I'll show subsequently, on whether or not you can meet your dividend payout ratio. Thirdly, if it turns out that you need to do equity raise because you can't get debt on good terms, the issue becomes a matter of dilution. The issue becomes one of dilution. Can Mr. Bashiru, please?
Apologies, but Bright, you're the main host now, so you're going to have to mute everyone. Let's mute everyone from your side.
Okay, give me a minute, because I'm also sharing my
Thank you to everyone who just joined. We have 99 participants now. Please just mute yourself so you're not interrupting the broadcast, please. Please mute yourselves. Thank you so much.
Okay, I've muted Mr. Bashiru.
Thank you.
Thank you. So when the company goes out to raise money, it reduces on its balance sheet. And if the assets are undervalued, that will be quite critical. Now, if the company needs to raise $500 million to come in and invest on a balance sheet of $1 billion, think of the dilution if they are going to do it with equity. If it's not equity and it's debt, think of the debt servicing requirements and the impacts on dividend payouts. Those are important things to bear in mind. Here is the reason why there's so much confusion. You need to make assumptions in order to value Agyapa. But that is the way we do it for everything. There is nothing in the world where you don't make assumptions in order to do evaluation. The question is whether the research backing the assumptions and the careful thought and analysis can be defended. So we've said that this is the simplest way you can value the asset. And the reason why this is the simplest way is that you don't have to sit down and then make a determination what will happen every year in terms of price and production. You have to find out the income stream, then plug it into the equation. You average out, and I'll explain to you why the averaging out actually works in a moment. You average out what is the likely production of gold, what is the likely price over the long term, what is the effective royalty rate or the average royalty rate, and then you do a computation by assuming that because the price of money changes from year to year due to inflation and other factors, you now need to discount back. When you've done that discount, you get a certain number. This is a very basic tool that everybody who's done a first year finance program in the universities understands. There's nothing complicated about this part. So nobody, it's not a formula that you need to go and invent. It's a very obvious formula. Every first year undergraduate understands. The question is what is going into them? They have said that the gold production number is 2.9 million. We will prove subsequently that it's far more. They've said that the price forecast for the remaining life of these projects is something in the region of $1,300, something like that. And then more or less those are the two big areas of dispute. if we can kind of address how much the production is and what is the likely price horizon, we'll get close to some valuation that makes sense. We think that even if you use their numbers and you think carefully about it, and then you make provision for some growth, even very minor growth in production, you still don't get anywhere close to $1 billion. You get like $2.something billion. But there is evidence to prove that this is something in the region of $3.5 billion, this asset. And the reason why it's important that we value the asset properly is what I've said to you. It is going to be the core of the company, so it's balance sheet to do anything else. And then second, if we undervalue the asset, the money we get upfront will also be low, and therefore we are selling ourselves short for half the asset. Then for the remaining half of the asset, I also prove going forward that the capital gains dimension of it is not as simple as it looks. So keep these numbers in mind. It's very simple. How much gold you produce every year, at what price? If you bring all of them back forward by removing inflation, removing all the other issues that a discount rate will normally take into account, you will get some money about which is equivalent to what the asset should be worth today. The question is that people disagree about what numbers we should put in for the average annual production, the average price forecast, the average royalty rate, etc. The question is whose numbers is backed by assumptions that everybody can validate on the ground. That is the issue. Secondly, we don't have to account for reinvestment issues and the rest, because that will just increase the valuation of the valuation. So we are not valuing the company now. We are valuing the asset which is going to be used to fund the company. So that's why I've said, okay, what about reinvestment? You know, when the money comes, you reinvest it. So if you want to do a proper evaluation of Agyapa, you need to value. That's not possible because the company is not operating. So we have an asset which we are going to put into a company. We must value that asset and then say, therefore, that is the money that we are going to get through the listing process commensurate with the asset we are giving to pay this company. That's where the issues are. Second, there are a number of other assumptions that you need to be able to take into account, which is that, you know, when it comes to the costs, because I'm looking purely at, you know, the income stream. What about the cost side? If you have the valuation, net present value, you don't really need net present value here because the money that was going to come, the GRA that will go and collect that money, we've already paid for it. So this entity has this asset has no cost to realize. It's not the company itself, think of it carefully, it's the portfolio. What is the portfolio of royalties worth, which we are giving to this company? How much we give it to this company? That is the analysis that we are conducting today. So don't talk about things like, well, what about the cost? What about issues to do with reinvestment of the money that comes in? They are not relevant. It's important that you bear that in mind. Okay, so let's look at the production element. I mentioned that when you're thinking of the valuation, the two main dynamics that are critical is the production and the price. These are the assets that have been listed. In the agreement, they call them mineral projects. The problem is that when you say something like Ahafo or Achim, it makes no sense because we are talking about many projects, multiple leases, multiple concessions in some cases, and within that, there's a whole bunch of things happening. Sometimes one particular producing asset inside that Ahafo or Achim or Asanko is down, another is up. So it's really difficult to call something a project and give it a name and think it's that simple. There are a lot of things happening within what they are calling Ahafo. So if you think of Newman's Ahafo, for instance, at the very least, you have to consider about 80 different projects and think through for each of these projects what is really happening there. It's the same for Achim, Asanko, Bibini, and a bunch of them. Some of them you have simple situations, like the current Chirano, for instance, is fairly simple. A Dua Prem is not that simple, etc. So these are what they are calling the mineral projects, which is essentially whole operations. I think the better word to call it is call them operations. So these operations of the mining companies sometimes spread over very large tracts of land is all the gold from those places. They are calling the geographical area. All the gold that is produced in those places is going into this portfolio. Now, here is an idea of where we are going with gold in Ghana. If you take a long-term view of gold from 1990 to now, you see that we've succeeded in growing gold from less than 800,000 tons thereabout. In fact, around 1990, we're dealing with something around 500,000 tons thereabout after the IFC investments to gold that is now hitting 5 million ounces. So you see like a 10-fold increase in gold production in time. You will need to be guided when you are doing your analysis by that long-term history of how much gold is going to be produced over the lifetime of the agreement. And then you try and average out that long-term perspective. So you say, okay, if the gold is going to grow at a certain rate, Then if next year, this year it was 5 million, it's going to go to 5.5 and 6. And then what is the average across? That is the best way to do it. Not to take today's gold production, 2.9 million ounces, and use that to strike some kind of analysis. It makes no sense, because we're talking of gold production throughout the period of the agreement. And as some of you already know, the agreement is not determinate. The agreement is that every time in that geographical area, lease is extended or there's a replacement, like we've done several times. Remember that Anglo Gold Ashanti started off as, just one mine in Obuasi, and that 1897 lease, they kept renewing two leases in the same geographical area or the same concession for years. At one point, Anglo Gold Ashanti, or what it used to be called, whatever, Ashanti Goldfield, had like 400 square kilometers of concessions in Ghana, 400 square kilometers. And then we've now reduced it to 200 and something square kilometers. So think of those concessions in those terms. That we're talking of large tracts of land, and gold can be found at any time. And what is the likely production horizon? And what is the likely production in that horizon? And then average them out. If you do that, that 4.9 million ounces we are suggesting, instead of the 2.9 million ounces, starts to become reasonable. And we'll go into a bit more detail how that works. So when you look at some of these analysis of how much gold is covered in the agreement today, as I've told, the government thing is about 2.9 billion. But when you look at pure disclosures, so this is work by Edna Osei and Alexander Malden, you find out that the people that are disclosing royalties, they constitute something in the region of 86% of the production. If they constitute 86% of the production, then the proper way to look at this is to say that the amount of trackable assets that we are talking about is in the region of about 4.12 million ounces, etc. So trackable production. You also have to take into account that if you just did a linear model and you said, okay, we start off with a particular production today, what is the likely production going forward subsequently? And then you just do, we did a 1990 to 2020 average increase in production. And that gave us something like 7%. We then reduce it further to be conservative to about 4%. And then we said, what is the discount rate that investors will measure this against? And we found out that the government was seeing 5%, which is very widely used in the industry for assessing this type of values. We increase it, which would decrease the value. Remember that when we increase the discount rate, we decrease the value. But just to be more conservative than the government, we use 6%. When you do that simple linear projection of gold growing at 4% per annum, and then you strike the analysis based on what is the proportion of the gold that we have royalties being disclosed for, and you do that projection, and then you take the 75.6%, you still hit the $3.5 billion. You get the point. So take the gold as we produce it today, project it over the period that is concerned. After having projected over the period that is concerned, now find an average, then strike the price, which we'll come to very shortly. And when you strike in the price, use that price to do the analysis, you'll find out a particular valuation for the gold worth today. And that is the $3.5 billion, which mirrors the earlier analysis that was made. Is there another way you can use to try and get a handle on whether this analysis is correct or not? One way to look at it is to say, okay, when we take Agyapa in Ghana, how much gold is likely to be produced over the term of the agreement? And if we take that gold, and how much is the valuation valuing that gold per ounce? If you do the analysis, you find out that we are anticipating a production of about 5 million, anticipating royalties of about 5 million ounces of gold. So I'm not talking about royalties in terms of dollar. I'm not talking about royalties in terms of ounces. That's one metal. 5% or 4.8%, depending on whatever royalty figure you use, of the total production of that period. You find out that you're talking in the region of something like $200 per ounce is how it's being valued. Of course, there's time value of money. So I can understand why the value of the ounce over the whole period will be low, but it's ridiculously low. Because we can look at two quick examples of people that have gone into the private market, by which I mean they've just gone to countries, gone to mines directly and done a deal similar to what we are doing, where they've said, okay, give me your future mining allocation, allocate to me some of your future mining output, and I'll give you money today. And when we look at how much they are valuing the gold at, you will see that the price, effective price per ounce, is in the region of $173, $500 thereabout. If you use a similar amount for Ghana to value the gold that we've got, something in the region of $150 to $550, you come back to the conclusion that it's between 2.5 to 3 times undervalued. Let me make this point very clearly. You look around and you look at deals that have been done where royalties companies have gone to mines and said, give me gold, give me royalties, your royalties from gold, or give me a percentage of your gold production, often called the net smelter requirement. Give me a certain percentage of the gold you produce going forward at a certain value, and I'll give you money today. Then you do a computation of, in that deal, what was the average price per ounce that that company paid? If you did that analysis, and I'll give you 2 quick examples that you can check yourself, Rubicon and Royal Gold, Royal Bafokeng and Triple Flag, you find out that they typically value the gold at around $473, $500 for similar duration, because then the present value of money then comes into play. So though the gold may be selling at around $1,500, $1,500, $900, the effective price of that gold is around $473 to $500. In our case, because gold price have taken a turn and the longer horizon looks better, we expect to get even more than that $500 per ounce for the gold that we are giving in advance, or we are giving up in advance. And we see that we're only giving it at around $200 per ounce. So that is another way that you validate that, in fact, the private market, that is not going to the stock market, but talking directly to royalties companies, will value our assets way more than putting it on the stock exchange. It's an important point, which then established the argument I was making, that the stock market can undervalue the assets for all the reasons I gave earlier. And even if the government was sincere, it could still lead to a situation where the stock market undervalues the asset, as opposed to doing direct deals. So when it comes to cash upfront, because we are talking of 3 things, right? Cash upfront, cash every year, and then the value itself of the asset growing. When it comes to cash upfront, the private markets will do better than the stock markets based on the data we have. And then we're going to talk later about the cash payouts, etc. This is also quite important because this kind of gives you an idea of some of the issues that have arisen. When the government uses the data that they used, most of it from the Ghana Chamber of Mines, which comes from the Mineral Commission, you looked at what they provided, the data that they provided, and you find out that there are a lot of things missing and some of them are just plain wrong. And then we don't know whether it's deliberate misinformation or what the issue is. So in 2020, we anticipate that the companies that they've listed as relevant will produce about 4 million ounces of gold. And the reason is very simple. One has the second mill coming up, Subika is coming on, back on stream. All of those as additional value ounce production. Anglo Gold, Obuasi is coming back on stream. It's going to add like, it's already come back on stream, December 2019. And I think it's been producing all throughout this year. That's going to add additional volumes. They decided not to include gold that will come from Namdini in the course of the agreement's life. Mensing Gold, Phoenix, and Azuma, they were not just included. If you look at Azuma, that's 100,000 ounces they omitted. Mensing, they are talking about 100,000 ounces as well. Prospecting is continuing. So they left all of this out in their calculations. And if you look at that carefully and you add it, you find that even today, we're already talking more than the 2.9 million they are talking about. They're talking about 4 million ounces already today. Then they refused to look at the prospectivity going forward, the amount of gold we are going to find in those geographical areas. So let me give a very simple example. When you look at Anglo Gold, for instance, and they tell you how their thing is structured, they've got a bunch of licenses that, border, the main mine. So the Boasi that they are talking about, they've got the Kubi lease, but in the way that they will do the analysis, they won't strike out Kubi, right? They will just add all of it under Boasi. And then inside that analysis, you need to take into account the fact that some of these resources are extraordinarily fertile. It's just the price of gold is what has kept them from producing. So if any time gold price increase, they can ramp up production if they are willing to invest. And so they need gold price to increase for a few years to assure them that we have a new turn in the pricing of gold, and then they'll make these investments for the production to increase. And that is why it does not make sense to use gold production today and kind of just sit there and say we've done an analysis of the valuation. It doesn't make sense because you've given them large geographical areas and gold can be found at any time in there. Some of these companies may sell a part of the concession or do a transfer. They can do mergers and acquisitions and other types of arrangements, which will bring in resources, which will lead to development. And look at Asanko alone, look at their mining leases and the license areas we are talking about. You're talking about 53 square kilometers, 28 square kilometers. And yes, they'll just put the Asanko. I mean, what is Asanko? What do you mean? Is it any of these projects? Obviously, some of them have very different remaining life left on mines. Some of that has been increased already by Parliament to 15 years. But in some cases, already they are prospective licenses, and therefore, when those convert into development, you're going to get another 30 years. So even the 15 years is just a quick shortcut people use. If you do a mine by mine analysis, a concession by concession analysis, and we've done for about 60% or so of the assets that you've listed, you are getting to something like 21 years minimum of remaining life left. So when they use 15 years, they're not being clever, because they're just assuming that those leases that were extended by the Parliament ends or terminates the lease life. Not really. And part of that is also reflected in the very short lease life remaining that they put on there. Sorry, a reserve life remaining they put on there, because it does not take into account new reserves coming on stream. And in a lot of these areas, they are still being prospecting. And as the price of gold increases, the prospecting will increase and production will increase. So it's quite simple from just looking at what they entered. So what they entered is what I put at the top. What I put at the top is what they entered. So they put Asanko there, just Asanko, and they put rate, and they're giving you an effective royalty rate, and they've told you the average production and then the reserves, and they said the mine life is 10 years. But you can clearly see that we are talking of 6 different projects, all of them with very different mine lives, all of them with very different prospects. A bunch of them are going to continue renewing the licenses, etc. So that 10 years is grossly underestimating the potential of Asanko, and that's just one. So if you go through all of these one by one, you start to see the problem. Just look at Asanko thing that they are talking about. Look at where the mines are. So the mines are the little blue and white things that are there. Look at how spread out this whole thing is. These are all projects. Some of them, in new investment will change the output, etc., etc., etc. So when you look at what they have done here, and you read it and you thought it was smart, oh, okay, there's one thing called Asanko, and it's got 10 years of mine life, and this is the amount of resource and the rest of it. It's just based on a very quick snapshot without giving you the detail, which you can see when you look at Asasi, which is just one project called Asasi within the Asanko concessions. And you can see that there are 2 main parts of that project. It's Asasi Main and Asasi South. When Asasi South is increasing, is that time that the other one is, kind of like ramping up. And then they have a different rates over time at which each of these mines kind of come up and down. So in effect, depending on how much investment that's going into it, the cut-off grades and the rest of it, you find out that because the cut-off grade that these companies are quite conservative nowadays and the rest of it, the prospectivity of these mines are immense if the gold price were to go up. Take another one, Goldfields Takwa, and think of when we say Takwa, and we just leave it at Takwa. What do we really mean? In account the measured resources, the indicated resources, and the changing profile of those resources. When you do your mine-by-mine analysis, you must, at the very least, have a strategy for understanding how you will measure the increase based on the fact that when the price of gold increases, the prospectivity prospects also change. Then we have what we call evergreening, which is that some of the mining companies, they are too powerful and they are too big, that you cannot really, underestimate the ability to keep these assets going for many, many years. This is just Obuasi. And we went to Parliament in 2018 and asked Parliament that we should give them a whole range of concessions. And part of those concessions is to make the first 10 years extremely concessionary for them, because going past 10 years is when they will start making more money. And then the mine life can then be extended beyond 22 years. So you know all of this. And yes, when you are accounting for Anglo Ashanti or Boase, whatever Boase means, you made it very clear that it's 15 years of mine life. But you know very well that you went to Parliament to tell them that they should make the first 10 years extremely lax in terms of the covenants and obligations, because Boase will not be making a lot of money in the first 10 years. And then afterwards, they will start making a lot more money. So some of these dynamics will change and they'll make more, the grades will improve and everything else. And yes, so you put 15 years there. And you've not made any adjustments in terms of your thinking about what the likely output of Obuasi will be throughout this period. In fact, you've left production 0. So you see, this is the top there is just me taking from their graph one by one and going through it to give you understanding what's behind that number. So when they say that Obuasi will produce 0, it's simply because 2016 to 2019, Obuasi was down. So when I'm now valuing the asset going forward, I should put 0 there. And what kind of analysis is that? And then you have people telling us that because they are investment bankers, we shouldn't look at the analysis that they are doing. Makes no sense. Then look at the fact that they are accounting reserves. Because when they are looking at the reserve that they are looking at, they are not doing the production guidance step by step, looking at mine extension projects that are ongoing. And therefore, they say Chirano have just 3 years of mine life. No, Chirano is not just one thing, right? They are doing projects in Chirano that is continuing to increase mine life in the Chirano asset. And you need to take into account the fact that they are impacting only about 10% of their concessions, and they will continue to expand as the price of gold increases and they're able to invest more in converting more resources into measured resource, not indicated resources, measured resource, and more measured resources into reserves. That transition between resource and reserves is a dynamic picture, which your analysis must accommodate, and which the analysis currently does not even acknowledge exists. Unbelievable. They're also underestimating production potential because they're not going behind the deals to look at how, in specific instances, you have a case where you have particular technology needs, and technology will change. So refractory processing will improve in the next 5 years. So by 10 years to come, some assets that were considered uneconomic will be suddenly economic.
Sorry, right. I don't mean to interrupt you, but you have about 3 minutes left. So if you
can... give me about 5 minutes and let me run up.
Sure.
Thank you. So when you look behind and you go to some place like in Zima and Akrofu area, you find out that if it wasn't for legal reasons, they will be producing about 100,000 ounces a year. And therefore, they don't just put 0 there or completely underestimate that possibility that the legal issues will be resolved and the production will increase. The other thing is also overstating the price volatility, because I've now finished production. I'm talking price now, which is the second major driver of the valuation. So we discussed production and why their numbers don't add up. They're not talking about price. The view is often people take a very short view of gold, let's say 2 years. And about gold is very volatile. So how can you make any analysis whatsoever about gold pricing in the future? It doesn't make sense. We are forgetting that, as we've explained, the life on this agreement, because of its indeterminate nature, means that about 30 years to come, this agreement will still be valid because they are finding more gold in the geographical areas. The way the agreement has been drafted is like that if they do any renewals inside the same geographical area, the life automatically extends. So you need to look at a far longer horizon. And when you look at gold over a far longer horizon, do some adjustment for inflation and a number of other things, you find out that the price of, we have entered a new regime around 2000, where the price of gold is really quite upward and smooth. So you need to take that long-term view of gold in order to come to the conclusion, as we've done, that the price of gold has entered into a regime where it will increase over time, and $1,800, which is below today's price, is very conservative. And yet, when we use $1,800 or the government's preferred $1,300 and the like, they often argue that we are being overly aggressive about the price of gold. Not true. We are entering a bull market in gold. It's quite clear that the new support is somewhere $1,900 to $2,000. And even if we don't think about it in the next 2, 3, 4 years, certainly over the next 20 years, which is when this agreement really comes into its own, over that period, the price of gold will definitely continue to increase. And therefore, the average over that whole period cannot be $1,300, several dollars less than what it is today. And also, when it comes to the effective royalty rates that a lot of people are not paying attention to, the fact of the matter is that in a lot of places, they're actually paying more than the 5% due to issues around forestry commission and a whole bunch of other things that I don't have time to go into. But in simple terms, the royalty rate of 5% is sensible, given all those dynamic. As well as the fact that if the gold price moves up 1,700, it increasingly becomes fixed at that 5% rate in the long term. So you need to take that also into account. Because I don't have time, I'm kind of struggling, but I think these are important points. Let me try and make them quickly as I can. The transaction structure the government has given is not correct. It is not, the gold is not going to Agyapa royalties in JC. The gold is going to Agyapa garner, which is not going to be listed on the stock market. So when we think of valuing our assets, we are only concerned in what is in the agreement in terms of how much Agyapa JC has committed to buy the assets that the Ghana entity owns. It's that simple. So the Ghana entity's gold is what we are valuing. when you decide to go and put that on the market, first of all, you are taking 50% of it or 49% of it upfront. So that money is gone. It's not going to go to any stock exchange. You've lost that value. So we can look at even 49% of the value and say, is it correct? And it's not the market that will determine that. The 51% is also not going to be determined by the market. And I'll explain very soon why. So in effect, you have a situation where the government thinks that it's the market that is dictating the pricing, and it's not true. And the reason why it's not true is very simple. When you're doing an IPO and you want to find out what is the pricing of the asset that the entity that you are listing, one of the first things you do is try and find out the price for the entity, which is linked to the entity's assets and future cash flow, because the cash flow comes from the assets. It's the assets that generate the cash flow. Now, if you don't value the cash flow properly, you're not valuing the assets properly, and therefore the entity also properly. Because where in this case, the bare minimum the company makes is money we give to it, almost by default. We need to find the value of just that money, even before thinking about reinvestment. Now, so once you've done that, you get your fair value estimate. And then it's up to the arrangements you've made with the underwriters to determine the price offer. So the price offer, that the preliminary offer price that you give, is very powerful and dictated by the investment bankers that are working with you. And in a book building method, they will often have allocated that through the book running process significantly way before you get to the market itself. So the asset is going to be valued by the agreement, which has already said that's $1 billion. That asset is then going to be given to this company to go and list. And the price of this entity will be determined by the underwriters and the investment bankers. And then they will put it onto the market. And if the market then thinks the asset is underpriced, the market will shoot it up temporarily. During that period, a whole bunch of investment bankers will make millions of dollars. And that is where we are extremely concerned about the fact that it may end up hurting us. Because when the underwriter sets the price and does the allocation, the idea that you can wait till it gets to the public market to benefit is junk. Everybody will hold it as long as they can. The 25% that typically you have to put in the public float is going to be grabbed up by a lot of other institutional investors. And then that will therefore mean that people that make money are those who benefited from the underpricing, not actually even the shareholders ultimately. Secondly, the IPO process themselves will not go to the shareholders. They go to the company. And then the company now has only one covenant, is to pay for the gold you've already allocated to it. And that price is already set. So the idea that somehow they're going to make more money through the price appreciation is completely meaningless. I'm not going to go into a lot of these details because I just don't have the time, and I think I underestimated how much time I needed to explain these things. But the simple point is that when the company is small, like Agyapa will be small when it goes with limited trading history, etc., it will be heavily undervalued. That has been the history of royalties company for a long time. The ones that are heavily overvalued are the ones that have immense trading pedigree and are quite big. It's also highly skill sensitive in terms of the actual multiples that you can get on the stock market. All of that means, therefore, that like I've tried to explain, the capital gains will also be low. Because once the company stop, and you can see that from other companies that are royalty companies. You can look at their capital, see that only one of them in the whole list of about 8 of them is doing very well from a capital gains perspective. And it's the ones that are the biggest and have the longest trading pedigree. So that's quite problematic. That would then lead into low dividend payouts. So the expectation that the cash that will be coming will be significant is not true. Then you have the point that I've already made, which is that the investment needs of the country are huge. This is a company worth only $1 billion. How much is it going to raise in order to be able to come and give $866 million to Newmont? How much is itself going to be able to raise with this $1 billion balance sheet? And when it starts with no working capital, there's the cost of raising the IPO itself, which is about 10% of the money raised. We should treat that as an interest rate. So when you are comparing to what would be the case if we went to rather borrow, we should not assume that equity is free. Equity is often the most expensive way to fund anything. So the cost of the IPO of about 10% of the total amount raised is very significant. I want to end by reminding all of us that we've had experience of similar arguments around internationalization. So if no one will give me just 2 minutes, I'll remind you all about the famous Ashanti gold matters. When we started with Ashanti gold, the argument was made that when it comes to internationalization, it's the only way to enrich a particular portfolio and to maximize the value of that particular portfolio. So we went and then we listed on the stock market. We reduced our stake from 55% to 35%. The market cap at that time was about $1.8 billion. So in effect, we had more than about $600 million stake in this deal. And we also had the golden share. You couldn't make certain decisions without consulting us as Ghana. Then they started to complain that the golden share is undermining the pricing. The golden share should go up because the golden share is not good. And in 2002, when we were making this argument that the golden share was bad, we had 17% stake, but we had the golden share. In 2014, we gave up the golden share. Look at the change in valuation of our stake. Our stake went down from about $81 million to $51 million. So giving up the golden share did nothing whatsoever to increase the value of the asset, despite all the promises that we've been made.
Thank you.
When you think of—
Thank you so much. Thank you so much, Bright. I apologize for cutting in. Unfortunately, we have run out of time for your part. But there are a lot of people asking for the slides. So I don't know if you don't mind sharing it after the presentation. I'm sure they can go through it. Also, there are some questions for you, which I'll be, asking after Ben's presentation. Let me quickly acknowledge Professor Akilapa Sawyer. Thank you for joining us, sir. This is a very busy man. I met him earlier today at Star Ghana. Thank you for making the time for this. Professor Akosia Dakwa, you're here with us. Thank you too very much. From Malawi, we have John Nyangulu. He's a National Coordinator for African Students for Liberty. He is also with us. Thank you so much. There's also Mukasiri Sibanda. He's with Tax Justice Network Africa, and he's also part of us this afternoon. Thank you so much. Welcome. And now we're going to move on to Ben Boachi, and I'm going to ask Ben Boachi to give us the position of the CSOs Alliance. Thank you so much.
Thank you very much, Noel, and good afternoon to everyone. I think Bright has done justice to a lot of the things, so I will try to simplify my part of the conversation so that we can allow participants to ask questions and also contribute, because essentially what we're trying to do is to listen to others on what is missing and what other perspective other people have. But what we've been trying to do as civil society is to try to see how this agreement really optimizes Ghana's royalty share from gold production, and to see whether the interest of the country is protected. And time and again, when you read the agreement and you look at the conversations that are happening, you get increasingly convinced that we could be better off taking a step back to consider other options perhaps on how to optimize the royalties. So I will try to look at, on the face of the agreement, how does Ghana benefit from this Agyapa transaction? There are a lot of things around the technical issues which Bright has dealt with, and broad governance questions, which I would also try to repeat some of them. So when you look at the agreement, the first thing that comes up is the number of leases which Bright spoke about, and the projects that have been assigned to Agyapa. Initially, government position was that we are only giving 12 projects to the deal, and therefore there are other leases that are not covered in this agreement. But when we started punching holes and emphasizing what is stated in the agreement, I think the conversation has slowed on that part. But it's important for us to keep hammering that. So Ghana is granting 48 leases. That essentially assigns geographic demarcations to the transaction. But on those 48 leases are 12 companies producing and 4 others that are just preparing to go into production or prospecting. And, like Bryce said, there could be many projects on these leases that would increase the reserves and also output from those leases. So we have to bear that in mind. It is 48 leases assigned, and also it could be many projects on those leases. Essentially, also, if you look at those leases that have been assigned today and what they represent as far as royalty is concerned, those companies constitute about 95% of royalties that the state gets from all minerals in Ghana. So it is not just 48, or 12 projects that have been assigned to this transaction, but significantly 95% of royalties that we receive from that. But what is even intriguing in this whole transaction is that when you look at some of the statements in that agreement, it's not just the 48 leases, but Agyapa is also granted first right of refusal for any lease that will want to go the same path of royalty transaction. So if the Ghana government decides to dispose of any other lease, the agreement is crafted such that Agyapa will have to be considered first. What is even much more worrying is that in considering Agyapa for other leases, they stabilizes all the terms of the Agyapa we have today for future transactions. So every lease that you assign to Agyapa, which they have the right to refuse, it has to be identical to what we are assigning today. And that is incredible, for us to even imagine why we can foresee 10, 20, 50 years down the line and say, we are giving all those rights to Agyapa in today's terms, when we do not have control over technological advancements, reserves, and all of that. So in the agreement, that is what it is as far as allocation to Agyapa is concerned. So I will move on to the question about the valuation. And also again, Bright has done a lot of the technical stuff. So I will just probably fill in on that. So when we're talking about the valuation, government position, we started questioning why 1 billion, and they started throwing numbers, and we started critiquing those numbers because initially we heard that Ghana was receiving royalty values around 150 million. Sometimes they would say 130 million. And we kept pushing that even in 2019, we had about $200 million dollars from our royalties. So if you really want to value the royalties, the most significant number is the 2019 valuation. And also the fact that you are 3 quarters into 2020, you should have a fair idea of how much you're going to receive for 2020. So those 2 years should be very critical in your attempt to value the asset that you're taking to the market. So they have shifted away from that. And now the current conversation is that the 1 billion doesn't matter because that is not what they are taking to the market. But we want to show that the 1 billion is very, very significant. So there are 2 levels of transactions. There is a transaction that assigns Ghana's interest in those 48 leases to Agyapa. That's the first level of transaction. So we have gone to Parliament and told Parliament that the royalty that we are going to receive from those concessions is worth $1 billion. And if you check the history and the background of this transaction, the investment environment have been very part of this transaction. The transaction advisors, the banks, they have been part of this transaction for 2 years. So shaping that agreement and insisting that Parliament approves the value means that they know what they want from that transaction. So it is important for government to come clean on how they got the $1 billion transaction. We need the variables. We need to be able to, within the context of all the technical issues that Bright raised, be able to be sure that government is thinking right. Government understand how the industry functions, and therefore we are not undervaluing the asset. But I mean, even if you look at a simple cash flow and discount any other future adjustment in production, you still can use the numbers we have today to project that the 1 billion is grossly undervalued. So you have a transaction that grants Agyapa all the royalties at 1 billion. What that means is that even though you can argue that Ghana government owns Agyapa 100%, Agyapa is in a different jurisdiction. Agyapa is not equal to Ghana government. And that has to be appreciated. Okay, because it's in a different jurisdiction, we have moved it away from our laws and our jurisdiction and deposited it in a Jersey, a different jurisdiction. So it is a corporate entity on its own that can take decision on its own. So we have to appreciate that that 1 billion is what we are giving as the value of our asset. And if you check the agreement, it says that that is our consideration of the asset, for the assets that we are giving to Agyapa. So it's not a simple matter of saying that is not what you are taking to the market. We are not interested in the market as of now, but we need to be able to convince Ghanaians that we are valuing the assets right. We understand what is going into it, and Ghana needs to have fair assessment of what it is granting to Agyapa, and that also helps you to understand what the market is offering. Because if you know how much your asset is worth, then you can decide that no, the market is not giving me a fair value. But if you put it at 1 billion and the market gives you 2 billion, you may be in a hurry to accept the 2 billion, but that may not even be a fair value for the asset that you are granting to the market. So it is important. The market has been part of the 1 billion valuation. The investment bankers have been part of that 1 billion valuation, and government needs to convince us how they stage with that 1 billion. And we can talk about how much they want to get from the market later, because that is what the market will be offering based on their own assessment. But how do we value the assets on our own? It's significant. So another point also in the agreement that we have to appreciate is the duration. And Brian talked about government using 15 years to do the evaluation and assume that some of the projects or most of them will be terminating at 15 years. But we do know that some of the projects have not even started. So obviously those are going to go beyond 15 years. But in the agreement, if you check the clauses that talk about the term of the agreement, there are no limits. So it says that when the agreements leases are renewed, automatically Agyapa's royalty from those leases continue. If you juxtapose that with what actually happens in Ghana's gold industry, you would find that leases don't expire. As far as the economics of the project show that gold can be extracted from a lease, the leases will not expire unless the company breaches fundamentally the agreement they have with the state. Because in all the agreements, and we've taken time to go through the agreements that are available to us, and all of them, you'll find statements that says that the lease shall be extended if the company can economically extract from the resources. So agreements, leases don't expire. So what that means is that Agyapa will continue to receive royalty from all those leases as long as the companies can justify the investment and also begin to discover more resources in the geographic areas that have been plotted into the agreement. So essentially what it is that we are giving those leases out to Agyapa for unknown period. So it then comes to another point in this whole arrangement, which the Attorney General had cause to complain. The fiscal stability that is provided in that agreement is incredible, right? So you are saying that the agreements cannot be renegotiated. So if you grant Agyapa 5% of royalties from Newmont, Anglo Gold, and all the other companies, the agreement bars Ghana government from renegotiating those agreements, either downwards or upwards. And that kind of stability is not supported by any of the agreements. There is no gold agreement that is so regimented to allow you to say that you will take 5% royalty forever, or you will take 3% royalty forever. When the economics of the project dictates that the fiscal terms be renegotiated, there are good faith provisions in the agreement that allow an agreement to be renegotiated. And Professor Akila Kwasoya is here. I mean, he's been so instrumental in renegotiating some of the agreements to ensure that Ghana's fiscal take improves. If those agreements were so regimented, we couldn't have renegotiated those agreements. So we cannot grant Agyapa that right to prevent Ghana from renegotiating these agreements. What we are simply saying is that if, for example, tomorrow gold prices drop to say $600 and companies cannot optimize their production with that value, they should shut down their mines, and Ghana cannot do anything about that. The country should have that flexibility to determine when to cut back and when to make more from the extraction of the resources. And all the agreements allows that flexibility and negotiation in good faith for that to happen. But we are seeking to stabilize, the royalty take from all the leases in that agreement. And that could hurt the investment climate quite significantly, because then you are saying that if you are coming, then you should also have a straitjacket and say you cannot negotiate certain specific terms of the agreement, as far as you also want to demand a stable royalty terms. So, and that again, I don't know how, the lawyers may help us. I don't know how you can even sustain this kind of provision in the agreement. So that automatically subject this Agyapa agreement to severabilities, which may land us in court for arguing some of these cases out when the companies demand that an agreement is renegotiated, or when the states want to renegotiate some of the agreement in future. I want us to also look at the status of Ghana as a majority shareholder in this whole Agyapa transaction, as we've been told. We keep hearing that we are going to maintain our 51% shareholding in Agyapa. But if you look at the agreements carefully, the assignment agreement and investment agreement, and what you find really is that we have ceded our rights as a majority shareholder to the independent board members and the minority shareholders. So Ghana, as a 51% shareholder, doesn't have the right to vote on issues that will seek Ghana's interest solely. So whenever there's an interest at stake, it should be aligned to the interest of all other shareholders before Ghana can vote. We cannot vote to prevent the election of an independent director. So when the company decides to appoint anybody, Ghana cannot vote to prevent the election of that independent director. We cannot vote against any shareholder resolution, even though we are the majority shareholder. And these kind of waivers really makes us limited to dividend shareholding, a majority dividend owner, and nothing more. Because when it comes to decisions that matter on how the company invests, what kind of portfolios they can actually go into, Ghana has ceded its right to independent board members, and also the company Agyapa, which is now going to be in a haven, the tax haven, in Jersey. So these are very significant issues that we have with the agreement. Again, the agreement is saying that we should not tax Agyapa royalties at all from the royalty receipts that they are going to get. At the same time, we agree that this is an investment. We have seeded all our resources and have quantified it as a lump sum investment into Agyapa. So Agyapa now receives cash flow and not technically royalties. Because if you even check the MIF Act, the Mineral Income and Investment Fund Act, section 28(5) states categorically that income accruing to the Republic from minerals paid to the fund by a mining company shall not be classified as taxes paid by the mining companies and shall not be expended as conventional tax revenue paid to government. What this provision really does is that it declassifies the royalty as tax.
Sorry, again, I do not mean to keep interrupting, but you have 3 minutes to go.
Right, I will sum up quickly. So it declassifies the tax and makes it an investment. So it's like Newmont bringing in $500 million to come and invest in Ghana. It's like Anglo Gold also pulling $500 million and over to come and invest in Ghana. We are happy to tax those companies. But when Agyapa invests $1 billion into our royalties, it is not subject to tax. And I think when we do that, we are only preventing the $500 million owner shareholders from paying tax to Ghana, and not really trying to tax, because the law that actually sets up this structure, this framework, really declassify the royalties as tax. So if the revenues that they are going to get from the royalties can be classified as revenue from their investment, the country has every right to tax them. And if you check all the royalty companies that we are trying to model after, they all pay tax. And the companies that they invest in pay tax. So why are we saying that for Agyapa, it cannot pay tax and just receive revenue from Ghana? So beyond these specific issues that are, in the agreement itself, are the very governance issues that we think we need to pay attention to. And we have been questioned, where were we when the agreement was going to Parliament and when the MIF Act was being set up? And the truth is that all of these things were done on the blind side of civil society, and we were never part of this conversation. We've been part of all processes in many, many laws that have been passed in this country. We've had opportunity to make inputs, make submissions, appear before Parliament, and argue on the side of Ghanaians to actually ensure that we improve some of these laws. With respect to MIF Act and the transaction documents that went to Parliament, we didn't have the opportunity to make input. No memos were received, or requests for memos were actually issued for civil society to make input into those processes. And if you look at now, we have taken 2 hours already making a presentation on this agreement. And we just oppose that with a 4-hour given to the plenary of Parliament to look at these 5 documents, agreements. It tells you that there was everything wrong with the kind of governance structures and speed that we took this whole transaction through. And there are also a lot of questions about why Ghana would want to even register in a tax haven. And again, the explanations that we are getting is just to protect the investors and not to protect Ghana, because we have the right to tax the revenue of Agyapa. We are waiving that because we want to go and sit in a tax haven and not allow Ghana to benefit more from the resources. So I want to end here, and then when we open up for the questions, we will start addressing some of the outstanding issues.
Thank you so much for wrapping up very quickly. By popular request, looks like Bright Simmons has a whole fan base that's threatening me if I do not let him come back and complete. So just 5 more minutes for Bright Simmons. If you can come back, please, and wrap up your previous contribution.
Thank you very much for being gracious, Norm. I'll quickly go through the key highlights of the points that remain. One is that the assumption is, this is some kind of Dutch auction or standard fixed auction price IPO. It's not. It's a book building IPO. That means you hire investment bankers to serve as either underwriters or sponsors. They then go and talk to investors, and they allocate the shares based on the final offer price that you make after you've got feedback from the market. That final offer price in the book building IPO is detected before you go to the market. So investors will have already bought shares, will already be holding the shares. You then go and put the entity on the stock market for the first day of trading, and typically the price will go up dramatically. But that benefit goes to those who were allocated the shares during book building. So the view that somehow the valuation itself will be driven by the market doesn't make sense, because the intraday gains will only come on the 51% of our shareholding. The 49% will already have sold out to other investors who will have bought it before it's even listed. That 51% gain will not remain, because as I show in the subsequent slide, when you look at typical trading day average IPO returns, you see that you get a huge boost in the first couple of days, and then it drifts back to the mean. So for Ghanaian shareholders who want to hold the 51% for the long term, the capital gain dynamic we are looking at is not the first day intraday boost, which they are saying that will detect the pricing. The pricing will be detected by the structure of the industry, which we have already explained, does not favor our type of royalty company that we are building in terms of its size and its scale. So that is a very important point, because a lot of the argument has been made that all this talk about valuation doesn't matter. It's the stock market that will detect. It's not the stock market. It's the investors that they've lined up to buy this, who none of us obviously know, who will detect it. And those investors have already made it clear that they will pay between $400 million and $500 million. And that's what the government has been briefing the international media and has been appearing in the international media. There's something strange about the process. The other thing I also thought that I should mention is that when we say the market will undervalue it, what we mean is that the nature of our particular royalty company, its lack of trading history, its lack of management that the market trusts and respect, it will lead to an undervaluation. I also wanted to quickly point out that we can look at the performance of most of the royalty companies on the stock exchange and see once again that when it comes to capital gains, your long-term share performance, which will lead to a rise in capital gains, it's only the big companies who typically benefit, and the vast majority of them tend to underperform. So royalty companies are not a magic to dramatically maximize your assets. And that feeds into the dividend situation. So we're not going to get the dividends we expect because the dividend yield is very low. You're talking about 1.1% typically. That amount is in the region of less than $5 to $10 million a year, which is far less than what we could get if we just keep the royalties or we do a private transaction. I've talked about the fact that the cost of doing the IPO should be treated as an interest rate. And if it's like about 10% of the funds raised, which is typical, then we need to pretend as if we're borrowing money and we're paying 10% interest rate. And the same way that we will not consider that a success is the same way we shouldn't consider Japan a success, given the cost of fundraising. I was talking to you about this issue around Goldfields listing when we're told that it's the golden share that was preventing valuation. We removed the golden share, our stake has actually dropped. Eventually, we lost every stake in Goldfields. Now, and we now own about 0.001% or something ridiculous, 0.01% or something ridiculous. And how we finally managed to lose every single stake we have in Anglo Gold Ashanti. It's a perfect example of how internationalization, when you don't understand what is at stake, matters. Two quick statistical points. In 1996, we earned $115 million from our assets in Obuasi, from, which is our Ashanti Goldfields, from royalties and dividends. Today, we don't get any dividends because we own 0.01%, and we get only $22 million in royalties. This was after we were told that internationalizing that asset will bring huge valuation, huge maximization of the value. It didn't happen. We also know that you can't always trust investment bankers. They were the ones who told Ashanti to hedge almost 50% of its output. It led to a situation where Ashanti moved from about $270 million positive cash to negative $570 million. The company nearly collapsed. It was the same investment bankers who were advising them, in this case, Goldman Sachs, far more prestigious than JP Morgan, if I may add. The last critical point I think I need to make before I go is the issue around the control, which Ben touched on. What Ben did not mention, given time constraints, is the fact that we had an option to go in and list as a sovereign commercial company on London. We decided not to go for that option. If we had gone for that option, we would not have been required to have a controlling shareholder agreement or address the issue of controlling shareholder agreement. We would not have required to ensure that all opinions are met through independent directors, etc. And independent votes on independent directors would not have been required. So essentially, we gave up so much by deciding to go for the main listing that we're going for a sovereign controlled option. And we need to ask ourselves why. Lastly, the JC point. I have a case study about JC that I will encourage everybody to find out. But it's anchored around this idea of impenetrable trust. JC is notorious for the kind of trust you can set up. So while this company is being formed, because it's being formed in JC, already being formed in JC, when you are doing the allocation of shares, you are moving shares from Ghana, that Ghana owns in JC, and you could be giving them to trust that nobody can penetrate. So that during the period that investors are allocating the 49%, that 49% could go into trust that nobody can be able to trace who actually owns those trusts. It makes some people worry that we might deliberately underprice in order to benefit those kind of investors. And it will be so difficult because of the trust system to figure out whether this is indeed happening. I ask everyone to go look for the US Senate Permanent Committee for Investigations report of 2006. In the case of Scottish annuity and life holdings, where a specific structure using trust was used to abuse shareholders to the point where it became clear that in the case of Scottish annuity, the offshore arrangement was purely to divert assets at an underpriced stake and benefit from the rebounds on the market during day trading. So in a lot of ways, there are a lot of problems with this agreement that is backed by serious research and the government needs to listen, and at the very least, respond comprehensively to these research-backed problems that have been identified and raised. Thank you so very much. I'm happy to answer questions.
Thank you so much. I was dreading having to come and stop you again because I was afraid of your fan base. But thank you for that. That was a mouthful, very insightful. I see there's been a very vibrant discussion on the side between participants. There are also a lot of questions that I have taken note of, and I'm just going to go straight into the questions because we don't have much time left. There are some questions for Bright. I advise you just take note of them. I'm also going to read some to Ben and then Franklin, and then we're going to let them come and respond. There's a question here about the gold production projections, and it's about the growth in the last 10 years. Is it above or below average growth for the 30-year period? Also, more broadly, is recent trend consistent with a full 30-year trend, or is it falling or rising? Which is it? This goes to Bright, if you can just note it down. Also, the facts and analysis clearly show that the fundamentals for the Agyapa deal are weak, if not flawed. But what is the guarantee that government will reverse it? This question goes to Franklin Kujo, so please note it down. There's still a lot of questions asking for the slide, so please, Bright, consider sharing that. There's also a question, what do CSOs suspect is the reason why government is pushing this deal through in the midst of these conversations? Another question for, so this question I am giving to Franklin. What the CSOs suspect is the reason why government is pushing the deal through. Also for Bright, it seems government have sought to undervalue the resource base, whether knowingly or unknowingly. But why will they do that? And what will they lose to listen to other valuations? That's a question for Bright. Now, can we look at the transparency issues regarding beneficial ownership? That's the Jersey secrecy. This question goes to Benjamin. So Benjamin, if you can come in and take some of these questions before we go on to Bright, please. Benjamin?
Yes, I'm here. So you assigned a transparency question to me. Yes, I think we are extremely worried that Ghana, after years, within the global space of championing issues of transparency. I mean, when we're passing our petroleum laws and, signing up to EITI, all was to ensure that we can account for revenues from the production end to the point of utilization. So that's why we've been worried that we're now going into a jurisdiction that allows secrecy to happen and blind trust to fester, as Bright actually indicated. There is no way you can actually know who the beneficial owners of the 49% is, even though it will be listed on London Stock Exchange, because it's a trustee that would show. And those who are built up behind the trustee, you are not really going to be able to uncover those countries. So it could be some people giving money to the banks to actually invest for them. And I think that is where the concern really is. And even the fact that, Ghana is now backtracking to now go and take a lead to a tax haven and invite people to join the country is really not a good example for us to be engaged in at this point. So, the foundation that we have built over the years, trying to improve on transparency, signing on to EITI, publish what you pay, PIAC, with oil, is something we can rather build on and not now, take the royalties and go and hide them in a secret jurisdiction that evades the kind of transparency that we fought for over the years. Yeah.
Thank you so much. I'll just call on Franklin. Franklin, if you can please answer the questions that were assigned to you, and then we can invite Bright Simmons to come in.
Well, listen, I'm energized in anger. I do not even understand the basis for going for this deal, except to say that there's no money. If the government had been very serious about, closing all the revenue gaps at the port, they would have been able to raise that money. We are losing 200 million Ghana cedis a month at the port. And you are doing this, and you are going to look for just $100 million. I'm more energized in anger as I speak. For those of you who are still asking what can be done about this deal, I thought this was going to be the the sunset for this particular conversation. But I'm sorry, it's going to be sunrise from today. We are going to energize the base much more. We probably will do a much more in-person conversation.
That we had the tail end of a lot of the structural adjustment issues. And for those that remember at that point, Boase was the main thing. And we started to liberalize again, and IFC got involved, and a huge amount of money was produced. Then you see a major uptick in production. And then in the 2000s, it stagnated again. A whole bunch of reasons are responsible. Part of it was because of the fact that some of the early expectations around internationalization had not paid off. So we then stagnated until we had another boom in the 2000s. So the question is, what is the average growth trend over that whole period of 1919 to 2020? It's about 7%. So per annum. So 7% per annum is the rough picture. Then when you take it down from 2000, because we had a slump, it goes down. It lowers the trend from 2000 to this period to around 4%. But, and here's a very important point, take a look at this very steep situation we are seeing in 2016 when we had the sudden boom in price. The boom in price from 2016 is also reflected when you go into the price picture that I mentioned. You find out that there's this particular price boom that is ongoing. And that price boom, to my mind, is twinned with the production boom, because when prices go up, a lot of supposedly uneconomic resources become viable reserves. And that is the equation to keep in mind. But we always know there's gold there, but if the price is not brilliant, we're not going to mine the gold. And that is a fact that is not being paid attention to in this deal, in the way that the government has structured the production volume forecast. In fact, they have no forecast. They just assume that we should just use today's gold production, which they are underestimating anyway. I think it's 2.9 million. I've just shown you that even today, you can easily find 4 million ounces if you look carefully by peering underneath each project, as we call it. Thank you.
Thank you so much, Bright. Kofi Bento is with us, and he wants to just chip in and give a bit of extra information. Kofi Bento, if you're here from IMANI Ghana, one of the vice presidents, the floor is yours for the next 2 minutes. Sorry, Kofi Bento, are you?
Can I make a quick point while Kofi is figuring out his mic?
Absolutely. Do go ahead.
1 minute. Okay, thank you so much. So on the issue of undervaluation, we don't want to ascribe motives to anyone. So let us do the politically safe thing by saying that undervaluation can happen at different points. If we're going to hire an underwriter, in this case, whether it's JP Morgan or Bank of America, and you have an agreement with them that, there's an underwriting agreement, and they are supposed to do the book running, they can also undervalue it. Because if their advice that the government is relying upon, so for instance, if all the analysis and all of those things is being done by a team out of JP Morgan, if that is the case, it's entirely possible for the underwriter to undervalue the asset, because if the market perceives that it's underpriced, and this market is not necessarily the global market as we are kind of thinking, it's basically the investors that they've talked to. If the investors they've talked to have been given an assurance that this is underpriced, then they will buy it, hold it, and when the stock debuts on the market, they will then flip it. And they could sometimes make as much as 30% of the value in the intraday trading. And I showed you the graph. I don't know if you paid attention to the graph. Here is day one. Here is how much the valuation shoots up the first day because it was underpriced. Then it starts to fall in day two. And before you realize, the long-term trend is somewhere here. But all those people that bought before the stock got to the market, they make this gain. So you can literally make $300 million just by knowing the right people who are handling the Agyapa transaction, because you'll be allocated shares in Agyapa. And this is not shares you can get, because the book runners are not going to call you. They're going to call their friends, and then they're going to give them shares. And by the time we get to the listing, the debuting on the stock market, the first day, 49% would have been gone to people that the underwriters like. And then they will flip it on the open market and get all the benefit. So there's a lot of reasons why, for this very well-studied area, IPO abuses is a huge flourishing field. And I encourage everybody to kind of understand more about how these things go. In terms of spinning, flipping, laddering, there are so many of these mechanisms for abusing IPOs to enrich investment bankers, which is why we really don't want investment bankers leading on this alone. We want resource governance activists involved.
Hello, can you all hear me?
Yes, we can hear you. Coffee
Sorry,
Bank.
I didn't unmute my mic. So
Okay.
first point I wanted to make was, I really don't think we can do justice to this subject on a webinar like this. And given the COVID dynamics as we have them now, I think we ought to do an in-person meeting. I mean, well-distanced, there are enough facilities in Ghana, and I'm pressing my colleagues so that we organize that. But that being what it is, the details, again, cannot be digested in just this, but I just want to make some quick points. Now, reason why I want to make the quick points is that we take them away and we can exhaust them later. This present arrangement as it is, one, it limits the control we have as a country today. It limits that control. The only reason why you will limit control like this is if you had the chance of extremely higher revenues or better outcomes. Unfortunately, after limiting the control, we actually limit the revenue or benefit we can get from our gold today. In other words, what we are making today is not likely to increase under this arrangement because the benefits will go to the investors. The detail we'll explain later. Then again, interestingly, it limits future control and it limits it in the most total way. I don't see why, if we want to improve the status of Ghana in gold globally, we don't try to do what South Africa has done by more or less localizing as much of the gold trading as we can in Ghana, in West Africa. South Africa has gone all the way to do Krugerrands. So why do we go?
That's very profound. I mean, the civil society movement has not traditionally been in the business of suggesting root, stem, and branch reform of the gold sector. That's not been traditional, like trying to tell governments about the entire policy value chain. What we've traditionally done is try and ensure that accountability and transparency are being upheld. So when it comes to what are the alternatives to Agyapa, I'll be able to give you some ideas, but this will also, I think that's a very important suggestion that you make, that perhaps we need to sit down ourselves and produce a roadmap for the country and then sell it to the public. And if the politicians will listen, fine. If they won't listen, the public will know we've done our part. Some obvious things we definitely have to do is to ensure that when it comes to the 10% equity participation, which is bringing nothing back. Number one, we should never do an Anglo Gold again, where we say that we're going to get percentage in the international parent, so we have no shares in the local. And then the percentage they give you is 1.5% of the international entity or the parent entity. And then you have nothing locally. Why? Because that is insignificant. If you have a 1% stake in Anglo Gold globally, what are you going to do with that? So what we should do is not do that again. That's one. And when it comes to the 10% that we have locally, we can begin to see whether putting all of that in a vehicle run by smart people who can ensure that they are using all the standard shareholder rights mechanisms to influence the run of the mines. Because sometimes what you observe is that some of these mines themselves lack capacity. So like if you look at the way that Kinross has been, got into the Bibiani project, for instance, so the Toronto project, for instance, a lot of it has been based on the fact that the existing producer was heavily undercapitalized and needed to raise international funding and couldn't do it. So if we had this vehicle that owned that 10% properly and managed it properly, and wasn't just looking for the dividends to come into a fund like we've done with MI, but look for an operating holding company of those assets that operates and therefore makes an effort to influence the way the companies are run, I'm pretty sure that the 10% returns will be better. Because this thing where they are paying zero dividend for so long is kind of frightening. So I think that's the number one thing we need to do. Number two thing we need to do is to begin to look at community mining, properly speaking. Because you cannot do community mining where you have all these small mines that are making a lot of money and they're not paying royalties, they're not doing anything properly, and collecting the money is so hard because they're not part of any of these internationally benchmarked transparency regimes. So we have so many people in small mines in Ghana who have made billions, right? We know a few in politics who've made so much money in mining, paid very little to the state. And we need to find a way for another strategy around those small mines. Government needs bigger equity in them because their costs are often far lower than the $890 ASIC that the bigger mines experience. So even when prices are like $1,200, they are still making money. How do we ensure that government is much more involved through its equity participation? So there are a number of ideas, but I think we need to do the research and as a civil society, come up with a civil society roadmap, and we'll consider that. Thank you.
Thank you so much. So before Ben comes in, there's a suggestion here that the Minister of Finance should hold a live debate with everyone about the Agyapa deal. So if you're from the Ministry of Finance and you're with us, you can note this down and then you can pass it on for discussion. I will call on Ben Boache now. If you can please take the questions. Thank you.
Yeah, thank you very much. I think that is a very important point to make, and that is what we've really been asking for, and the point why we need to suspend this whole transaction and engage deeply so that we can all help the process to really optimize the resources. But the question that was assigned to me, which is asked by Mr. Moore, I think probably he was asking a rhetorical question because that's what we are also trying to ask. And if you look at the slide that Bright presented, it really shows the distinctiveness of Ghana's royalty from what typical royalty companies actually do, because government royalty is the least risky revenue from the entire gold value chain. So if you decide to actually subject that to risk, there are a lot of questions that you really have to answer to ensure that you are actually going to optimize those revenues and not subjected to unnecessary risk. And from every point that you look at this agreement, we are only trying to subject risk-free royalty to significant risk because we need about $500 million today. When companies really goes to the market and say, we have reserves of say 200 million and we want loan to go and produce. They produce numbers that can commercially be extracted given the fines they've made. And for the country, we always give them the benefit of the doubt. At no point has Ghana been able to verify the numbers that the companies produce. We are here and always think that if you say you have 200 million reserves, produces and we'll take our share. So if you pick the company's numbers to value your asset, and over time, it's been proven that the values that the company give is always on the downside, then we have to really rethink it to see how we can better invest our royalties rather than copying what is typically different from what our royalties look like. Thank you.
Thank you very much. I'm just going to read out a few more questions. And there's a question here. Can you confirm, is government speculating by using our royalties and investing in the gold streaming and royalties business? Also, what are the risks? I think that some of the risks were shown in the slides in the presentation, but can you make this confirmation? This is going to Bright. We are told that government owns 100% of the company. Why do we have only one share allocated to those signed for Ghana government according to Jersey document? And who are those holding the shares currently? Because Agyapa shares at Jersey have already been allocated. So this is important because the issue of initial holders of the shares, I mean, that's why he's asking the question. This question I'm giving to Franklin. I'm allocating this question to Franklin, so please. Also, what is the current status of the deal? I mean, to the best of my knowledge, government is consulting further, but Franklin, if you can take this question too. Why should citizens support or object to the deal? I think, from listening to all the presentations, you can decide if you're going to support or object, but Ben, you can take this question. Also, given all the associated problems with the deal that have been widely reported and discussed, valuation, alternative listing options, opaqueness, and lack of engagement, the potential abrogation, should the MPP lose the December elections, etc., what legitimate democratic and civic courses of action would be available to citizens to pursue to restrain government from going ahead to implement the agreement if it is adamant and wants to go ahead with the deal? What will IMANI recommend? Franklin, please, you're going to take this question. Also, he says, I know a citizen can sue in court for an injunction, but is that likely to succeed, knowing the current disposition of our courts? This question is coming from one of the participants. Franklin is going to take that. What should be our biggest concerns about the deal? This one I should go to Benjamin. Please note that down. Who are the directors of Agyapa? That's another question. And this is going to Franklin again. Before I call Franklin and Benjamin to take these questions, I just want to quickly call on Alex Mould, who has joined us. If you can, we're giving you 5 minutes to give us your contributions. Thank you. Alex Mould, can you hear me?
Yes, I can hear you. Can you hear me?
Yes, we can.
Okay. I think I just wanted to give a perspective of what I think they want to do. My understanding from speaking and from listening to them is they're going to have a stream of royalties over the next 15 years, plus how many extensions they will get coming to this company, Agyapa, which is, in our view, about $200 million a year, up plus and minus depending on, you know, the gold price and the gold output. So let's just agree that that's a sum of money that this company will be getting. The real question is, what will the company be doing with this money? And my understanding is that they are going into the either going into the gold streaming and gold royalty business. And that means that they are going to be investing in companies all over the world, including Ghana. So they'll be diversifying their risk all over the world, but they'll be staying in the metals business, mainly, you know, the gold streaming business. There's only one company that really does this in companies, of which 3 companies control over 90% of the market. That means that they have the largest capitalization in the market, and anybody who owns a streaming business would own one of these 3 companies. So I think we need to understand exactly what they want to do. And doing that, they are going to take some risks. And the real question I have is, the PRMA is the Petroleum Revenue Management Act, which basically allows or specifies what can be done with our oil revenue. And our oil revenue includes our royalties and our equity share and also our paid-in capital and taxes and all of that. So it specifies exactly what we can do with the oil money. My understanding is that the argument has been that we've been mining gold for over 100 years and we have nothing really to show. Although the PRMA decides how we spend our money, mainly 70% of it on infrastructure, not more than 30% on budgetary support. Our Minister of Finance has violated this a number of times and basically broken the law. So even if you have a law, it's not going to really protect you or decide how they're going to spend the money. But at least there is going to be some way you can account for it. Right now, our money from gold goes into our budgetary support. So when some people say we don't know what is being done with the money goes into budgetary support. And once you approve the budget, they can use that money. Money is fungible in any way. So the 2 things I'm bringing on board is, one, they're taking a relatively risk-free stream of cash and investing it in a very risky assets on the stock market, where you have no control of the companies that you are actually investing in. You may not even be on the boards. You may, and also you don't have control of the management of these companies, and you are like any other investor in the market. And they are saying that it's very lucrative going into the gold streaming business. because you can be buying gold at discounted prices in the future. That is also speculative. And I think we just need to understand that we are allowing our Minister of Finance to take a revenue stream, which is virtually risk-free once it arrives in Ghana, to invest in other entities all over the world in risky ventures. And I think we should understand that if that is what he's doing, then we should have evaluation based on that, and not evaluation just based on the 200 million discounted cash flow over a period of time. That is if we want our Minister of Finance to speculate with our money. And that is what he will be doing by investing in Agyapa. It is a speculative vehicle for Ghana. And I don't know whether the Ghanaians understand that, and whether the Ghanaians want our Minister of Finance or our government to be speculating with our revenue. Thank you.
Thank you so much, Mr. Alex Mould. Mr. Alex Mould is a Ghanaian politician, and he's also the former Chief Executive Officer of the Ghana National Petroleum Corporation. Did I get that?
I don't know about the politician bit, but you can go on.
Okay, all right. As we are politicians, thank you so much. Thank you for your contribution. Now I'm just going to call on Franklin Kujo, if you can please take the questions. There's some questions on citizen action and how it can be done, if it can be done through the courts, why citizens should support the agreement or object to it, current status of the deal, and then there were some questions about who the exact shareholders are. Thank you.
Well, I think these are very valid questions. My reading of the minister's body language, and indeed even his speeches, are that he's not really going to bend. And I think that is quite unfortunate. While at the same time, he and his team are talking to people he believes are critical to the conversation. So it can only energize everybody up and then ensure that we ask more questions. I'm more in tune with the recommendation that we should have a live debate, an open debate. And I do hope that they come on board, even though Alex Mould thinks otherwise. Look, I think it's not just about saying whether the deal is good or bad. It must be based on the data and the evidence. So the data and evidence that has been produced here this evening should be juxtaposed with the ones coming from the government side. And toe to toe, we go through it. I think we can do that. When we do that, we can then of course, we can then dispel all notions of, underhand dealings. But this approach to suggest that, look, if we don't get this thing done by December 31st, we are screwed. Well, that's not for the minister in court to say. And as I said, I thought the sun was just setting on Agyapa. Actually, it's going to be sunrise from tomorrow. And I think that we would activate all our antennae, local and international, to have this proper conversation. So that's all I've got to say. Of course, the questions about the directorship has been answered, has been obviously dealt with by earlier publications. But I suspect the point really is that those who suggest that the directorship is skewed in our favor, that's actually not the case. In fact, the number, I'm told even that if you read the agreement properly, you realize that for the Ghanaian side to even decide to add an additional director, the counterparty must agree to it. And if they don't like the director, additional directors, then it means, well, we go fly, we are going to fly our own kites anyway. So there's still this unequal relationship at the boardroom and clearly also on the market as well.
Thank you, Franklin. Thank you for that input. Bright, would you like to?
Hello, Noam, just a minute. Hello, Noam, can I?
Yes.
Okay, so on the court issue, you asked Franklin the question about the court.
Yes.
Okay, it should be clear that the court will not have jurisdiction in this matter ordinarily. The reason is that this was passed through Parliament. And when Parliament passes it, it has the effect of a law, all right? So it's not a court that passed, Parliament passed this. So the question should be whether the parliamentary process was regular. It was extremely irregular and flawed. In the first place, they did not even allow, memorandum from various portions or places you know, and then they gave them only 4 hours, which was very, very wrong. Now, Parliament also has a majority of the sitting government, which they whipped into place to pass this. Now, so that more or less cuts out the courts, and this thing can proceed as it is unless there is citizen action against it. So the court issue must be clarified in that sense.
Can we go to court and say that the process was flawed? It was later the
effective. A parliamentarian or a group of them, they can do a few things within Parliament. But for now, we can't, look at a court process. If we do, we'll have to use a totally different course of action. And honestly, I don't see how that will happen. So we should be very clear-minded about the fact that the courts cannot help us to solve this problem. It is Parliament that has to do something about it if they have any residual powers, or it will resort to citizen action.
Thank you so much. Mr. Benboache, would you like to put in any last remarks?
Can I respond quickly to something that Mr. Mould said?
Sure, please.
So I think that a lot of people have said that we need to value start the valuation from what the company will be worth after it's listed and it's in operation. I don't think that is entirely correct, because like we've pointed out twice, when we start the whole process, we are alienating 49% of our future royalties on a valuation determined by a legal agreement. So it's got nothing to do with what the company intends to do in the future. By the time you start, 49% is $500 million, end of story. And now we're talking about the 51% that is going to be on the market at some point and may be dictated by what the company does downstream. With that 51% situation, we've also pointed out that regardless of what the company does over time, we do not have the means, even if that company was to do very well, to subject that company's investment policy to Ghanaian policy interest. So even if we decided that, the speculative analysis works in favor of future maximization of the value of the company, it has no real grounding in our policy concerns, in the sense that 49% is sold at $500 million, determined by legal fiat. It doesn't matter what happens on the market and what the company does subsequently downstream, whether it invests in mines or it doesn't invest in mines and just keep the royalties and invest them in gilts or risk-free assets. Then the 51% is controlled by the company, and the money that comes in, whether they declare dividend or not, etc., is all controlled by independent directors who can decide that they don't even want to invest in Ghana in order to achieve true diversification, which the current strategy pretends exists already, but doesn't exist. So I wanted to make it very clear that it's not something that we can just leave to the market and make an assumption that if this is the nature of the company you're going to do, then we should try and value it based on investment prospects of the money that they make. There are two levels of analysis. The first level is already alarming. Thank you.
Thank you so much, Bright Simmons. I called on Mr. Benboache initially. Benboache, would you like to put in any last remarks?
Yes, I think on the issue of the governance, I think now we are told that there was also a question about what will happen to the community share of the resources once 75.6 is given to Agyapa. I think we've been assured that the 20% will continue to go to Agyapa, but we should bear in mind that once government receivable is constrained, the less they would disperse to the communities. Even though we are supposed to put 20% into the MDF, the Capping and Realignment Act now puts it at 12%. And even that 12% is not disbursed. So you have about 7% going into the MDF fund. So if you are constrained, by selling shares and not receiving the revenues that would have come from royalties into the future, it will be much more difficult for government to continue to disburse to the communities. And that's an important point that we will have to make.
Thank you so much, Benjamin Boache. I'm sure that answered some questions on the governance aspect. Professor Akila Pasoya is still with us. I'd like to call on him to please make some remarks. Professor? Prof, can you hear me? I think Prof is not immediately.
Hello?
Prof, can you hear me? Professor Sawyer?
Hello?
Yes, please.
No, this is not Prof. But if Prof can hear, maybe you should check the mute on his.
Yeah,
Hello,
it's
Prof?
unmuted, Prof.
Okay, fantastic. Prof, we're listening.
And why we need to put this whole thing in Jersey, which effectively puts Ghana out of control. And the tenure that has been given the directors, which is more or less secured, and effectively removes Ghana from any real control of what they do. I think while Prof is, arranging himself, we should keep that in mind and demand an answer to that.
Thank you so much for that contribution. Is Prof ready? Kofi, can you please just mute yourself?
Yeah.
Thank you. Professor Sawyer, are you ready now? Hello, Prof. Okay, unfortunately, Prof is not able to fix his mic, I believe. I hear a lot of consensus about calling for a national debate. So again, I'm throwing it back to any representatives of the Ministry of Finance. If you're here, please ensure that this goes to the right table. And if you can facilitate a national dialogue surrounding around the Agyapa agreement, that would be very welcome. Professor, are you available now? No, I think Prof is still not available, but we have actually overrun our time, and time is a social contract. So we promised you 2 hours. We've run over by some minutes. I would like to thank you, every one of you, for tuning in. Thank you also to our resource persons. Franklin Kujo is one of our resource persons, and he's the President and Chief Executive Officer of IMANI Center for Policy and Education. Also, we had Bright Simmons, he's also Vice President at IMANI, and we had Ben Boache, he's Executive Director at the Africa Center for Energy Policy. I see Franklin has been able to become the host again. Thank you very much. So most of you will be receiving the slides. If you do not receive it, please get in touch with Franklin. IMANI is also going to be organizing further conversation around this topic. So there's likely going to be a physical conversation, which we are all looking forward to. I don't know about you, but I have been well enlightened by this conversation. I am now equipped about most of the details concerning the Agyapa agreement, and I will definitely be making my voice heard in the informed contributions going forward. Thank you to all of you. Thank you to our resource persons. Thank you to our participants. Have a great day.
Thank you, everybody.